industry. And the next session before lunch. This session is about emerging market perspective by Mr. Ajay Kapur, who is Asia Pacific and emerging market equity strategist, Bank of America Merrill Lynch. He has been one of the most highly regarded franchises in equity strategy and has been consistently top 3 rated in a range of major global and Asian external survey over the years. So now that investors have been bullish on Asia and emerging equities, this session will particularly analyze why they're being bullish and what are key market risks affecting flows of fund coming into Asia and also coming into emerging markets. What's the market outlook for China as the world's second largest economy? And also, how about the economy in Japan? What are key driving factors and what could support growth in Asia and especially in Japan? What's the potential growth for Japan economy overall? And also, we would dig down into profitability of listed companies in Asia, especially China, Japan, whatsoever, and see what are key driving factors that could support economic growth and also the growth particularly in Asia. And the key driving factors is also the flows of fund that is coming into emerging market and also the risk factor that we take a look at, and also the Fed fund rates that could affect market outlook overall. Okay, ladies and gentlemen, please welcome Mr. Ajay on the stage to begin his panel discussion.
Thank you. Good morning, everyone. My name is Ajay Kapur. I'm the Asia Pacific and Emerging Market Equity Strategist for Bank of America Merrill Lynch. It really is an honor to be here and to be able to share some thoughts with you. I'm going to talk about really 3 things since I cover all emerging markets and all Asia Pacific markets. I'll talk about, the first is, I think very important, especially if you're an investor in Thailand, as to why global growth is disappointed and why a lot of the experts have been over-predicting growth and over-predicting bond yields. Very important for portfolios. And I think now finally people are beginning to figure this out, and it's becoming a bit more consensus, lower for longer. The second part is, I think, more relevant. Thailand is an Asia-Pacific market. It's an emerging market. So what happens to those big, broad asset classes obviously is going to be important. So I've been bearish on Asia-Pacific and EM for about 5 years now. Now I've changed my mind about 3-4 months ago, and I'll share why. And I think it's people didn't believe me 5 years ago on the way down, and they really don't believe me on the way up either. So I'm going to try to persuade you why I think you should believe in the Asia and EM story going forward. And then lastly, not shown here, is that having said all of that good stuff, that for the next few months, because these markets have run up quite a bit, I think we might just pause for breath because a lot of these markets have gone up quite sharply. So I'll talk a bit about that. So let's dive straight. I'll probably speak for about 30 minutes or so and then see if you have any questions. So first thing is global growth. So I'm actually going to skip this because I've already talked about it. So as you all are well aware, since the financial crisis, world activity, world economic growth has been much slower than what was predicted. And let's take a look at those charts. So these dying caterpillars are really growth forecasts for various years, so 11, 12, and so on. And you'll notice a pattern here, that all these caterpillars are dying. That guys whose job it is to forecast this, world economic growth, tend to start very bullish, and then as the year goes on, they get less and less and less bullish. And then they start again, and then the same pattern emerges. So that's a lot of years, like 6 years up there. And so this to me is what is called a consistent repeated mistake, with absolutely no adjustment in your opinions about the future. And that's happened again for this year. And this is the IMF, but you can look at Wall Street, you can look at other guys whose job it is to do this. And as a consequence of this bullish opinion that everything's going to be happy and rosy the next year, just wait, give it some time, unfortunately, the bond yield forecast, some more dead caterpillars for you. So all these lines are the bond yield forecast for a particular year, going back about 10 years. And you'll notice one thing, that all of these lines, except for 1 year, which I think is 2013, all these lines have dropped. Now, in simple English, what that means is that every year for the past 10 years, guys whose job it is to predict bond yields have over-predicted bond yields. Bond yields are always and every time going to go up. But every year, they actually go down, year after year after year after year after year. So, I'm an analyst, so it's hard to predict the future, and I make mistakes. But I can tell you, I haven't made the same mistake 10 years in a row. You truly need to be a genius to be able to do that. It's just like flipping 10 heads in a row, so that the probability is very low. But I think this is important that we know when we listen to experts that, hey, this is going to happen. You say, okay, hang on, I want to see what you have been saying, because if you're making a persistent mistake, I'm going to give that a discount. If you say 5, I'm going to think 2.5. And that's just the discount rate that you have. So I think now, finally, I think people who forecast bond yields have figured out that the world is going to be slower. So let's talk about that. Let's sort of think about that. So to me, there are 3 reasons why the world is going to be slower for a very, 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 very long time. However much you think it's going to be otherwise. So the first is we're old. The second is we're indebted. And the third is we're unequal. Now, I'm sure every one of you in this room already knows this. But I think when you put these 3 things together and you see that it's very difficult to, if you're old, you can't become young. You're just old. If you're indebted, it takes years to work that off. And if your income distribution is unequal, it takes a revolution to fix that. And so these are not easily reversible things. So let's just take a look quickly at how old we are. So I'm going to show you a chart. Now this line is just it's the percentage of rich countries that are old. So you can see it's 100%. All of them, all rich countries are old, old being defined as percentage that have their working age populations that are peaking out. Now if you go back in this chart, in 1985, that's just about, 30 years ago, none of them was old. So these are rich countries. 30 years ago, none of them was old. Now, all of them are old. And that's it's irreversible. Okay, how about emerging markets? Because a lot of people think, yeah, that's just the rich countries, but emerging markets are pretty young and there's going to be a lot of growth there. Well, these are pretty big emerging markets. So China, these lines are working age population ratios. Working age is between 16 to 64 divided by everybody else. And you can see that most of them, China, Russia, Brazil very soon, Taiwan, Korea, have already seen peak working age population. By the way, Thailand, same situation. Thailand's an aging country. Strange but true. And so the only countries that are not really old are South Asia and some ASEAN countries and Africa. But those are not large economies. So the world, whether it's the rich part of the world or it's the emerging markets, are generally old. And when you're old, you tend to slow down. Now, it's not because it's granddad and grandmom walking the dog, sitting at home and watching TV, and they're not in the workforce. That's not the real reason why countries slow down. But it's really it's a sort of a weird reason why. Sometimes people ask me, why aren't people having children? So this is from Japan. I'm going to be there in 10 days at our conference. I think it's very basic, and I think we all understand it. So this is in Japan. This is a shocking chart. Why people don't have children. Well, so the blue line is the number of Japanese men in that age group, 18 to 33, that don't have any relationship with a woman. Right, whether it's girlfriend or wife or fiance, so it's a 61%, no relationship. And then women are not that far behind. 50% of them don't have any relationship with a man. So I'm thinking, even I can figure this out. If you need a baby, the leading indicator is you have to know somebody from the opposite sex. That's like a basic sort of stuff, right? So this is happening in Japan, and it's now happening in other countries too. So just in case you were curious, why the birth rates are falling, that's one reason why. People are just too busy taking selfies. Okay, so let's look at the real reason, why there's a connection between when you get old and why the economy slows. So here the yellow line is the working age population ratio. Now I'm going to focus on Japan, and the blue line is property prices on the top left. And it's basically, when you get old, you don't need office space and you don't need new property to live in. Right? So you can see Japan, the market peaked out in 1990. Ireland, Spain, UK peaked out in 2005. And then once the market and property peaks out, you've seen this in Thailand, 97, the economy does very poorly and you tend to slow down, you tend to have a financial crisis. So the connection between being old and the economy is not granddad and grandmom sitting and watching TV at home and not working. It really is that when you get old, property demand peaks out. That's the real reason. And so the collateral value for the banks peaks out. And you tend to normally have a financial crisis, a fast one or a slow one, once your demography peaks out. And I showed you earlier that for most emerging markets, the demography is peaking out. So that's just house prices. The vertical line is when you hit peak working age population. You can see that population peaks out, house prices peak out, and therefore your nominal growth goes down quite dramatically. Right? So that vertical line is when your population working age peaks out. Your nominal GDP goes down by half. You can't run away from this. It's very, very hard. You can raise the retirement age, but you can't get property to go up. Okay, and that's the Chinese story. So that is, the world is old, and therefore it's probably going to be slower for longer because the property cycle has peaked out for most countries. The second part is the world is indebted. Okay, so I think you already know this. There's some charts for you. So the blue line is developed countries. So post-crisis, you can see that debt has stabilized. It's not rising, it's stabilized. China is the worrying one, it's in red. So Chinese overall debt to GDP now is about 250%. I've just updated this chart recently, so it's now equal to developed country levels. So it is a worry, no doubt about it. And most of that is corporate debt. The green line is other emerging markets, non-China. I think they're fine. There are a few here and there that have issues, but for the most part, they're okay. So why is this important? Well, it's important because, as we all know, if you want to run and you have a big rucksack full of a lot of stones, you run slower. That's the logic. You have a lot of debt, you have a lot of debt service, a lot of your income goes in paying your bank, and you don't have a new credit cycle. So that's the proof of what I just said. On the left-hand side, if you have low debt, so rucksack empty, no stones, you can run very fast. Right-hand side, rucksack full of a lot of heavy stones, you can't run that fast. Okay, so a lot of countries on the right-hand side. Big rucksack, a lot of stones, can't run that fast. Okay, so that's the debt part. The world is unequal. Let's move to the third part. So I've talked about the world is old, the world is indebted, and now we come to my favorite subject, the world is unequal. For the most part, for most countries, the income distribution, wealth distribution is very unequal. And I think this is a reason why my old professor, Professor Bernanke, cut rates, did QE, Janet Yellen's continuing it, ECB is doing it, BOE, BOJ. They're all doing this QE stuff, and they've made rich people richer, which is, I have no problem with that. But it hasn't really worked in getting the world economy moving. So let's examine that. So I want to just give you one or two charts on how unequal. I've just used US data. So this blue line is the wealth, not income, wealth of the top 0.1% of the US. That's, I really don't like decimals and ratios. So 0.1 means 1 out of 1,000 people, just to simplify. So there are 1,000 guys in this room. One guy has 23% of the total wealth of people in this room. And that's the same as the rest of the 90%. Which is 900 other people. So one person has the same wealth as 900 people in a room like this with 1,000 people. Okay? Now that wasn't the case in 1975. You can see the blue line. This one rich guy had maybe 7% of the wealth. whereas the other 90 had 35% of the wealth, 4 times what this one guy had. Now both of them have approximately the same amount of wealth. Okay, so that's just life, and there are reasons for this. So this is the global distribution of income. So what's happening now with Brexit, Donald Trump, it's obviously the middle classes of the developed world, which is, if you look at the far right, so those blue lines, blue dots that are below the red line. So those are the guys who have lost out in the last 30 years. The far right is the top 1% they've gained, and then the middle part of the chart is the emerging market middle class, so people in Thailand and in China who've done exceptionally well. So there's been a silent collaboration between very rich people and the emerging market middle class at the expense of the developed country middle class. So those guys are now sick of it, protesting, demonstrating, and so on, voting for this to change. But let's get to the nub of the question. So if you're very rich, your savings rate is very high, and that's the blue line on the top. So if you're very rich, there's only so much food you can eat, so many houses you can buy, so many cars. So if more and more income is going to rich people, and if QE is inflating their asset prices, they're feeling very good about life, but there's only so much they can consume. Whereas if you look at the lower line, that's a savings rate of the bottom 90%. If you give a person in the bottom 90% $50,000 a year, he or she will spend the entire amount. The savings rate has been 0 for about 100 years, close to 0. So to put this in English, rich people don't spend too much money as a proportion of their income. If more and more of the pizza, more and more of the national pie is going to rich people, they don't spend it. If you don't spend it, your economy can't grow that fast. So the more unequal a country and the wealthier rich people become, the slower the economy becomes. It's just like a maths thing. It's a mathematical, it's not a very complicated thing. Right? So, I don't have any moral opinions on this. I'm just telling the story the way it is. So that's 3 reasons why the world is going to remain slower for much, much longer. We're old, so the property cycles peak out. We're indebted for the most part in the West and now in China. And most countries are unequal. So, sorry guys, we're stuck with slow growth. Now there's some ways around it, so you can do fiscal policy, you can do restructuring and so on, but it's very hard, it's very tough, because you have to deal with elected politicians, legislatures, and so on. So the world's going to be slower. I hope I've made that point. Yeah? Okay. Now, why did I spend so much time? Because Asia Pacific and emerging markets are basically global growth plays. So the world's going to be slower. We're swimming upstream, which is much tougher. But I think the tide has turned for emerging market equities, and let's talk about that. So emerging markets, you don't need to focus on all the gory details. So we account for GDP, about more than 56% of the world's economy is emerging markets. But the lowest bar, 17%, we account for only 17% of the world equity market. So we must be doing something terribly wrong. We have big economies, but hardly any market capitalization. So the starting point is pretty good, and here's the valuation reason. So this is just the 5-year performance of emerging markets, and I'm reasonably simple. As I get older, I get simpler. If it's low, it's probably going to move up. If it's high, it's probably going to go down. And I think people have a huge, huge problem with this statement, because when it's high, they love to buy more of it. It's what Warren Buffett said about hamburgers. Right? It's like the equities are one of the few things where the more expensive they are, the more people like them. And then the cheaper they are, the more people dislike them. So I'm looking at emerging markets. I said 5 years ago, back in 2011, I didn't like them. Now I'm saying, this could be anything. This could be fish. It could be soybeans. It looks low. It's probably going to go up. That's my very sophisticated reason. Okay. Let's look at another chart. This is a 5-year return versus developed markets. So they've obviously underperformed a lot. And the last time they underperformed this much was in '98 when we had the Asian financial crisis. We have no such thing right now. Again, I'm thinking they've underperformed so much. 5 years later, when I draw this chart, the blue line's probably going to be higher, right? In other words, we're probably going to outperform. I'm going to take that out. And I think one reason is just the valuation. So this valuation is the blue line is the market capitalization to GDP for emerging markets. It's very low. It's close to the Asian crisis lows. And then the developed market cap to GDP is super high. You can see how much has gone up primarily because of QE. Okay, so the gap is very large between developed in red and emerging in blue. So the relative valuation is pretty good. This is just the price to book for Asia and EMs. Again, it's one of those, the chart is so low, it's probably going to go up in 4 or 5 years. Don't ask me why and how. I mean, I'll talk about it, but I'll try to attempt some reasons. But it looks pretty low to me. So time to get a bit excited. That's the US valuation in blue, EV/EBITDA, very high. Yeah, so Ben Bernanke and Janet Yellen have done a great job. They said, we're going to make the market go up by doing QE. Everyone's going to feel good, especially if you're rich, you have a lot of stock, you're going to feel so good, you're going to go and buy a lot of stuff, and the economy is going to do better. That part didn't work out, right? Because I said rich people save a lot of their money. And Asia is in yellow. So that gap between the valuations now is 5 points. It's very large. It was that large in 2003 and then in the Asian crisis. So I'm reasonably confident the yellow line Asia will begin to outperform. Okay? So that's the valuation part. This is the dollar. The dollar is fundamental to whether it's Thai equities or Asian or emerging market equities. You can see that. So the yellow line's a dollar. When it's going down, actually the currency is strengthening. So for emerging markets, for Asian markets, a strong dollar is terrible news because the money goes back into the US and these markets tend to have crises and do very poorly. So I think your dollar opinion is going to be very important. If you think the dollar is going to get even stronger, having already appreciated 35%, well, then you need to be bearish on Asia and emerging markets. My view is when stuff is so strong, it doesn't get much stronger. Right? My simple view of the world. Okay, it's already gone up 35%, and I'm going to skip that and then talk a bit about fundamentals. So fundamentals obviously do matter, apart from QE and dollar and so on. So this is some basic stuff. So our return on equity, top left, has gone down massively, which is why we've underperformed compared to the US. And that's because our margins, EBIT to sales, have gone down. But more importantly, bottom left, our asset turnover. Sorry, I'm getting a bit geeky on you, but this is just sales divided by assets. This is why our ROEs have gone up. And the bottom right is our leverage. We've become very, very leveraged. Okay, that's not a great sign. So we need to get higher margins, top right, and we need to change our asset turnover to go up. So that's the fundamental reason. I'm going to try to persuade you now using a few charts as to why margins and asset turns will get better. This is a powerful chart. So the blue line is the capex to GDP. So if I run one steel plant, I'll make a lot of money. But if everyone in this room also opens up a steel plant, then none of us is going to make money. That's the logic. So if everybody invests, sorry, there's too many steel plants. So when that blue line is coming down, that's a lot of steel plants. Too many steel plants. We had this in Thailand in the mid-90s, so you're familiar with this, 20 years ago. And so when you make too many steel plants and too many property developments, then the yellow line, your margins begin to fall. And this is with a 3 to 4 year lead. The good news in Asia is that for the last 3 or 4 years, we have not been constructing too many steel plants and too much stuff. So it's already baked into the cake that our margins are likely to get better. So that's just a chart. If you're on the right, you've cut back your capex a lot. Korea, Greece, China, Turkey, Taiwan, Thailand, a little bit, not so much. So the point here is less investment is a good thing. I know you hear the opposite every time. We're going to invest in this, a bridge, infrastructure, this and that. So to me, I don't like investment at all. I want to be the only guy with the steel plant. Nobody else can build one. I love that because then I'm a monopoly provider. I'm going to make a lot of money. Okay? So maybe for the economy, a lot of steel plants are good. But from a capitalist perspective, not so good. Okay? So I like underinvestment, less investment. That's what Asia has been doing. Second part is our currencies, the blue line. Blue line going up, our currencies are more competitive. When we get more competitive, we steal market share from somebody else. We make more money. Our currencies have become more competitive. That's a good thing. Margins should begin to pick up. Last point is, I want to show this one, monetary policy. If policy is easy, interest rates are coming down like they are across Asia, across emerging markets, the cycle is going to turn, assets, sales to assets are going to pick up. So I don't want to bore you too much with this stuff. This is just like fundamental research. But the takeaway is our return on equity, which is what matters to equity markets, has gone down quite substantially from 16% to 11%. I think it's going to go back to about 14% in a few years. And that's going to lead to a re-rating. That you have absolutely no need to look at that chart. Okay. Let's talk about China. Very important. Now, I meet clients from all over the world, and I live in Hong Kong. I've been there since 1992. And I find that the further away I go from Hong Kong, the more people are bearish on China. And once I go to Boston, New York, then they're like supremely bearish. Even in Europe, they're very bearish. So the only guys who are sort of not bearish are the guys who live in Hong Kong. Singapore also, reasonably bearish. And I mean, I have some sympathy for that view, but not too much sympathy. It's the largest economy in the world on a PPP basis. It's the biggest emerging market. It's the biggest Asian market. And things are not as bad as people think they are. This is pretty important. So let me try to phrase that properly. Everybody is an expert on how bad things are in China in the old economy. But very few people are experts on how rapidly the new economy is improving. So there's a massive asymmetry. Perfect information on, oh, they have too much coal, too much steel, too much aluminum, too many ships. Everybody knows this. Everybody knows that. It's perfect information. Very few people know what's happening to the drone manufacturing sector in Shenzhen, or how quickly their tourism is expanding, or how great their supercomputers are, or how great their military equipment is now becoming. How great they no one knows. Very few people know this stuff. So my view now. Last year I was very concerned about China because I think they were doing some not so smart things. But now I'm much more relaxed. Not too relaxed, but much more relaxed than last year. So I think their economy is picking up because they have had a credit boom. And that's beginning to work through. The monetary conditions in yellow are picking up. And I think this is very good news. Interest rates in China are the key metric. So this is real interest rates. The corporate debt to GDP is about 190% now. It's a huge number, massive. And so to me, to some, that means the corporate sector is going to default. But I'm always confused. My left pocket has never defaulted to my right pocket, ever. Because I'm wearing the pants, and I can just, calm it down. Just tell my left pocket, just keep quiet. So it's very difficult to default to yourself. I don't know how you do that. I have 2 bank accounts at HSBC, but I've never had an overdraft for one versus the other, because I'm the owner of both the accounts. So think about China like that this is a corporate debt, but they owe it to themselves. So the government owns the banks, the government owns the corporate sector owes the banks some money, some of them might not pay. Yeah, that's tough. So the bank calls up the government and say, hey, this guy is not paying me, this is not good. So the government says, you're the bank, right? Okay, so we have this guy called the taxpayer. We're going to take some money from him and we'll give it to you. Don't worry too much. Right? So it's not the usual or default cycle. You can't default to yourself, is what I'm saying. It's unheard of. So the other way you can do it is you can look at that chart and say, last year, real interest rates were 10%. So if there's a corporation and real rates are 10%, real GDP is 5%, life is hard. You're about to die. Right? You will call up the bank and say, I'm about to die. I'm sorry. But what the Chinese have done very beautifully is they've taken real interest rates down from 10, 13% to about 5%. So now the corporation is saying, I'm actually not about to die. I can breathe because I can probably pay the interest. So that's a big positive development. The monetary conditions have eased, and so things are a lot better than what people think in China. And I'm happy to take questions on that. This is very different from the narrative from what I get from New York and Boston, that the whole place is somehow going to spontaneously combust and just blow up. I just don't believe that. That scenario could happen if and only if Chinese citizens take their wealth out of the country. It's a massive capital flight, which I was worried about last summer because the policy making was not the best quality. I think I'm less worried about it right now. So this is the earnings part. Again, same, everybody's happy in our business. Things are going to be awesome. And the year ends and things are not that great. So now in orange, we find that the earnings expectations from Asia are very low, only 2% for this year. It's going to be much, much higher for the reasons I cited. China is getting better. Our currencies are more competitive. So you're already seeing the earnings in Asia doing a lot better and surprising the analysts. I'm going to skip that. Monetary policy easing, and I'm going to go straight to the tactically neutral part. So I've talked about two things so far. The world's going to be slower for a long, long time, old, indebted, and unequal. I've talked about why you need to be bullish on Asia and emerging markets for the next many years, because our return on equity is going to get better. We're much cheaper in valuation terms. Everybody dislikes us. They're underweight or neutral now in emerging markets. But in the next few months, so I've been telling the story for about 4 or 5 months now, okay? But that's over. We're right now. What do we do now? What do you do with your portfolio? So I'm thinking, we've been running really fast. I'm just going to stop and take a breather. Yeah, tactically neutral for the next few months. And one of the reasons is that interest rates have dropped. U.S. rates now are 1.57, yeah, for the 10-year bond yield. They were supposed to be like 2.5, but that didn't happen. But now there's a consensus that bond yields are going to remain lower forever, just as the U.S. data is getting better on inflation, on wage growth, and maybe growth. And there's going to perhaps be a coordinated fiscal response. So now that everybody has moved to the bond yields are going to be lower forever, obviously is very important for Asian markets, because if bond yields in the world are going to remain lower forever, then you need to buy bonds in Indonesia and Thailand and Pakistan and Zimbabwe. Yeah, there's a search for yield going on, which is why our rates have come down and our multiples have gone up. But this has been well played out already and is subject to change of an opinion. So that's one reason. And the blue line this is my proprietary indicator. It's called risk love. So I think psychology is the most important driver of markets, less so than the ROEs that I just talked about. So this is what works in the short term. So blue line up means people are very happy. They're very euphoric. They're in love with risk. That's why I call it risk love. And there are about 35 things that go into it: put-call ratio, CDS, spreads, and so on. When the blue line's low, there's a panic. So if you look at those last 2 times the blue line was low, one was last August when China devalued. Everybody panicked. The world is going to come to an end. And then the second most recent lower blue line was in January of this year. Again, China had circuit breakers, a little devaluation. January and February were horrible months, as we remember. So those are the times that I tend to put out buy notes. Nobody believes me because everybody's scared. And it's easy to say this stuff, very difficult to do. And when the blue line goes up, then I get a little bit careful, pause for breath. So the sentiment is very high, and the analysts in blue are very bullish. Right, so the yellow line is the market, and the blue line is the analyst. So the market has moved up a lot, and now we find the consensus analyst is upgrading stocks quite vigorously. So we don't like that kind of confidence. We like people to be scared, fearful, panicked. The world is coming to an end. It'll never get better. That's a very good scenario for us. But we find that people are always on their screens. If you're in journalism, many of you are, if it bleeds, it leads. So I think the more you read, the more pessimistic you'll become. Especially if you read newspapers, financial blogs, because you sound more intelligent when you're bearish, and people give you a lot of negative news, because if it bleeds, it leads. So, what I always tell my clients is read less. Don't be such intellectuals. Don't become philosophers. You can as a sort of side hobby, but as an investment story, it's terrible. So now I find that the analysts are super bullish, and I just want to take a breath. So I'm going to pause myself. I've covered this stuff, and I just want to give you my summary. So first point is that the world's going to be slower for much longer because we're old, indebted, and unequal. It's going to be very difficult to make money when you don't have that kind of growth. The second point is that I do like Asia Pacific. I do like emerging markets for the longer term because I think our starting valuations are very juicy. I think our currencies are very competitive. Policy is quite easy. We're generally under-owned in most global portfolios. And most importantly, our return on equity is highly likely to get better from where we are. Having said that, point number 3 is that on a tactical basis, the next few weeks/months, people are way too happy for my liking, so I'm just going to pause for breath and then re-examine. So that's it from my side. Why don't I stop and see if you have any questions. Thank you very much. Are we taking any questions?
Yeah. We can open the floor for Q&A since we have like 15 to 20 minutes before lunch. So if any of you have any question, you can raise your hand or write down on your paper, and we'll have microphone coming to you as well. Any questions? No questions.
No questions. Well, thank you very much. Have a great day.
Thank you very much.
Yeah, bye.
Thank you for your insights.